Hi, this is Mark Chandik, and welcome to the latest edition of Prosperity Perspective. You ever heard the term, it's great until it isn't? Another way of saying that is don't put all your eggs in one basket. This video starts a 10-part series on the chapters of my book, 10 Financial Strategies for the Smart Investor, How to Avoid Common Mistakes to Build Lasting Wealth. We're going to start at the start, which is chapter 1, which is about the biggest mistake I see all investors make, no matter the size of their net worth. Technically, this is called concentration risk, but the more common saying is, again, don't put all your eggs in one basket. So how do we define concentration risk? Well, it is defined as the potential for financial loss due to an overexposure to a single counterparty, sector, or geographic region. The presence of concentration risk in your portfolio increases the vulnerability to market volatility and economic downturns. It's essential for you to understand this concept so you can avoid losing a large amount of money very quickly. So how do you become overconcentrated in your investments? The first is that as human beings, we get caught up in hysteria. We get caught up in the excitement of the latest trends. These are the topics we all talk about on the golf course or by the water cooler in the office. We all know what they are, and they come and they go. Even though we may feel that the hysteria is a bad investment, there is a pressure from all sides, media, friends, that reinforce this trend. It becomes self-fulfilling. If we don't take advantage of it, then we're going to miss out. Unfortunately, many of these trends should remain intellectually stimulating and not motivate us to invest in them. So let's say that you invested in the latest trend and you had great success. Success is self-reinforcing as well. So if a little bit was good, more is better. And so slowly, perhaps, you begin to invest more and more into that particular investment because you have done so well in the past. Let's say, for example, that you're aware that you're overconcentrated and you become nervous. And the little voice in your head or the feeling in your gut tells you to sell and take profits, but you don't. And that's because first, we may want to avoid taxation, so we don't sell. Or may want to max out our winnings. In other words, maybe there's a little more upside to capture before we sell. The gradual overconcentration and reinforcement and delay in selling all combine to create a very dangerous situation. Have you ever heard of the golf course test? If you're playing golf in your group, a bunch of guys or gals or people that at the gym that you work out with, they're all talking about the same investment and how well they're doing. I would take this as a warning sign and potentially limit your concentration. The title of this video is It's Great Until It Isn't Great, because that's what typically happens. All investments tend to have an economic environment where they tend to flourish. And if this economic climate is helping your investment, then you're overconcentrated in, things will likely turn against you at some point, and another investment will take its place. And all of the hysteria will move to that new trend. If we know that overconcentration can creep up on us slowly over time, how do we combat that as good investors? Well, the first strategy is to use diversification, and diversification is boring. However, it works. Diversification reduces risk in a portfolio and ensures that you're not overconcentrated. The second strategy that works is rebalancing. Rebalancing in a portfolio means that on a systematic basis, perhaps annually, you're going to sell the winners in your portfolio and buy the losers. In other words, sell high and buy low. Rebalancing is a disciplined approach to making sure that your asset allocation in your portfolio remains within an acceptable range of risk and guards against creeping into an overconcentrated position. I think the best example of this was in the 2008 financial crisis. Many investors in their early 60s that were approaching retirement were riding the wave of a very positive stock market. They may not have been paying attention to the risk in their portfolio, and they allowed it to become overconcentrated in perhaps growth stocks. When the financial crisis hit and the S&P 500 dropped 37%, they found that their portfolios were decimated. and they may have been surprised to discover that they had that much exposure to stocks. The result was perhaps that they had to work longer in order to rebuild their portfolios. What are the warning signs that you may be over-concentrated? First is an actual analysis of your portfolio and its holdings to determine if there is undue concentration risk. The second warning sign is more personal, and that's what your head and your gut are telling you. If you're feeling uncomfortable about the economy and your portfolio, then don't delay. Do the analysis and, if necessary, make the change. Another thing you can do is have a plan and stick to it. When I say a plan, I mean a very specific goals-based financial plan that includes an investment strategy that supports the financial goals laid out in the plan. By sticking to that plan, it helps reduce the risk of making irrational and emotional decisions based on the current trends and market rhetoric. I hope you enjoyed a conversation about concentration risk. And if you're feeling uneasy after this video, then take appropriate action. If you've enjoyed this video, hit the like button and the subscribe button below. Also request a free copy of my book using the link in the description below. Next time, we'll talk about Chapter 2, which is the risks of trying to beat the market. Until next time, this is Mark Chandik with Prosperity Perspectives. Thank you for watching. I'll see you next time.